Hey folks, Scott Rinehart here, Carlson Financial. Just want to start with a story from about 10 years ago when I walked into a casino to play poker for the first time at a casino. Now, don't get me wrong, throughout college and even high school, don't tell my parents, I played a lot of poker. It was one of my passions. I loved the skill involved, I loved the numbers involved, the math, and I kind of liked the risk involved too. So I spent like 2, 3 months studying up, playing with my friends, $5, $20 if we were really feeling gambly. We'd play a lot. And then I would play a little bit online. This was back in the days when you could play online. But I had never gone to a casino, sat down with a decent chunk of money and played poker. So one Friday afternoon, coincidentally, right around this time of year, it was Good Friday, so I had the day off. I remember that specifically. I decided to go to the casino by myself and test my skills at what I thought I was pretty good at. So I took $300, which at the time I was fresh out of college. $300 was a lot of money. I was really only planning on gambling 100 of that, and maybe if I needed to, dip into 200, and if I was really feeling good, maybe 300. So I get there and I'm ready to play and walk in, and there's only one table of people playing. And I quickly find out that the minimum buy-in for that game was $300. So my plans just changed a little bit. All of a sudden, I have to put in the entire 300 if I want to play. But you know what? I drove all the way up there. I figured I might as well give it a shot. What else am I going to do on this Friday? So I take my seat with my chips and proceed to play for all of about 35 minutes with guy to my left is, maybe in his 40s. He's hunchback with a hoodie on, headphones in, hasn't said a word to anybody. Probably means he plays quite a bit of poker at this casino. All right. The rest of the table, I can tell they play a lot together. A lot of them are retired or seem to be based on their conversations. And I can tell they play a lot. And, I quickly realize as I look around the room that I don't recognize who the sucker is at this table. So it probably meant it was me. Now, me not wanting to waste the day, I still gave it a shot. I tried my hardest, but don't have a good run of cards, and I lose that $300 in all of 35 to 45 minutes. The dealer asks, "Do you want to buy back in, sir?" And I sheepishly stand up and say, "Oh, I'm going to go get some lunch. I might come back," knowing full well that I was out of cash and was definitely not coming back. So I tell that story because it was the first time that I realized that I thought I had a certain risk tolerance, and quickly realized that I was not okay with losing $300 in 35 minutes. And I think a lot of you are in a situation where the last month or two, you have realized that your risk tolerance may not be as high as you thought it was. These are definitely unprecedented times. Stock market has dropped 30% in a short period of time, but now's a good time to realize that your risk tolerance may not have been as high as you thought, and now's a good time to kind of coordinate that so that moving forward you're going to be a little bit more comfortable without completely wrecking your retirement plans or your financial future. So today we are going to talk about COVID-19, coronavirus, and how that impacts your financial risk, how that impacts your financial future. So let's get started here. All right, here's my my disclosures I always gotta give you. And there's our information. So if you don't know where we're at here in Topeka, we're at 1201 Southwest Oakley. Of course, we're not meeting in person right now, but someday I'd love to see you at our office. It's a beautiful office that Carl has renovated. All right, so we're all here today because we're concerned. I mean, I'm concerned. I'm sure you are. That here in the last month, market has dropped a lot. Your account balances have, if you've been brave enough to look, have probably shed a decent number of dollars here in the last month and a half. Now, today, I'm not going to give you any major predictions of what's going to happen. You can ask our clients. I just don't do that. I don't give predictions because that's just impossible, right? We don't know what's going to happen. If we did, we'd have a lot more money than we do, right? We'd have that crystal ball. So we're just going to spend the next 20, 25 minutes giving you some concrete questions to be asking yourself, things that I think you should be keyed in on and really wondering about as you move forward. Now, a lot of you've been looking every single day at your investments. You've been reading the news, watching the news constantly. If that's you, if you've been stressed out and you're wondering if this is going to affect your financial future, your retirement plans, maybe you are retired or getting ready to retire, don't wonder. Let's just talk. So give us a call, 844 Carlson. Set up a time for us to just have a 15-minute conversation to see if I can give you any insights one-on-one. Now's the time to be doing that if you're really stressed out, okay? What makes it really challenging right now is if you're watching the news, if you're researching the markets by yourself at this moment, you can ask 5 different experts, 100 different experts, and you're going to get 5 different opinions, 100 different opinions of what's going to happen. We're no different. We have 4, 5, 7. We have 7 advisors here at Carlson Financial, and every single one of us has a different opinion of what is going to happen moving forward. Just got off an investment meeting call where every single one of us on the investment committee, there's 4 of us, we all kind of had a different interpretation of what today's news meant for the market moving forward. So, asking questions is important, but understanding that no one knows what's going to happen is key. If anyone is telling you they're saying, oh, I can guarantee that this is going to happen, that's something to be worried about because no one has that crystal ball. No one has the definitive answer on what's going to happen. These are unprecedented times. We're in uncharted territory, but there's never been a global pandemic impacting the global economy because we're much more global than we were with the Spanish flu. We're much more global than we were with past pandemics. So this is having the biggest effect on the world economy that we've ever seen. And no one can really predict what's going to happen from here. So if you have questions in general, about your own retirement, give us a call and we'll go over it. But today we're just going to give you 5 factors to consider. The first one is the speed of this market decline. Is there room left for the market to drop further? How does skyrocketing unemployment affect things? The duration of the recession we think is a major driver of how the market's going to recover. And finally, has COVID-19 peaked? Those are the things we're going to discuss today. So the speed of the market drop. This has been what has been so unprecedented, right? So 22 trading days. That's all it took for the market to drop 30%. Gave back all of the gains that 2019 and 2018 saw. 22 trading days, fastest 30% drop in history. Now I want you to see right there on your screen the second, third, and fourth instances. The second, third, and fourth fastest times that the market dropped 30% were all during the Great Depression years. Okay, So 1929, 31, 34 during the Great Depression. And that's when we saw 89% drop in the stock market. From 1929 to 1933, market dropped from a peak to the bottom of 89%. Now, right now, we're nowhere close to that. Okay, we were down as of March 9th. That's when kind of we hit the bottom. It was a 30% drop. Now I say bottom as of this recording. 30% drop. So we're nowhere close to what the market has dropped in the past with the Great Depression. Now, to be very clear, I do not think that we're in the next Great Depression. I do not think that we're going to see an 89% drop. We just don't know. Okay, so we have to, with our clients, we just have to tell them we don't know. So we need to do what is best for you now in case we do see, another 20% drop, another 10% drop. If we saw what happened in 2008 again, okay, that would be a 50% drop from peak to bottom. So those are the types of things that are probably realistic, could happen. Do I think that the Great Depression is going to happen again? No, I don't. It could, but we have a lot of things that are in place now that we didn't have back in the Great Depression that is hopefully going to prop up this market a little bit and allow it to not, just crater down into an 89% drop. Now, I read today that if we did see a Great Depression, the stock market would drop to the same level that we were at in 1992. I just don't see that happening, but we could certainly go lower from here. We have a lot of room between here and the lowest drop ever. So there is definitely potential that it could drop more. And we're telling all of our clients this. We're not trying to scare our clients. Our clients are set up to be able to withstand these things. It's just a reality of the situation we're in. Okay. So want to talk a little bit about how much you have to gain to get back a market decline. So let's say we lose 50%. Let's say the market drops 50%, kind of like 2008. Not saying that is going to happen, but let's pretend like we did. And just for easy math, I'm using $1 million that you had in the stock market. Okay, you lose 50%. It's pretty easy math. You have 500,000 left. That would hurt. Don't get me wrong, that would hurt a lot. So now, what do you need? What percentage return? You're at 500,000. What percentage return do you need to get back up to $1 million? You said 50%. Seems like that'd be right, but unfortunately, it's not 50%. A 50% gain from 500,000 only gets you back to 750,000. So what do you need to get back to the $1 million? You need a 100% market gain. Now, in the case of 2008, it took 5-6 years to get that 100% gain from the bottom to get back to level. The Great Depression, like I said, worst case scenario here, Great Depression took 25 years to recover to get back. Once again, don't think that's going to happen, but there is the historical precedence of it happening. So, we're just in a time where this recovery, it could be short-lived. It could only take, 12 months. It could be 6 months. Market does move a lot faster than it did back in the 30s, as you have seen. We have algorithms that trade automatically. We have high frequency traders, things like that, things that move the market a lot quicker. Everything's electronic now. New York Stock Exchange right now is completely shut down. We're first time in history that we're completely electronic trading. So that's, once again, unprecedented. So do I think it's going to take 25 years to recover? No. Do I think it could take 3, 4, 5? Absolutely. Okay. So Warren Buffett has said that it's insane to risk what you have for something you don't need. So what's he mean by that? Or what do we mean by that? So let's say after this 30% drop in the market, you have enough still where you're at to retire comfortably, to be comfortable, and live the life that you've been saving up for at today's levels. Okay, it would be insane for you to risk what you have just to try and get something you don't need. So if you have money that is safe at the moment, it would probably be kind of insane for you to put all of that money into the market, into some stocks that you think are going to do really well, just because you do hear some people saying now's a great buying opportunity. Depending on your timeline, it could be a great buying opportunity, but why take unnecessary risk? I tell that to my clients all the time, that if they're if they have their retirement plan in place and it's going to work just fine, why take more risk than is necessary? Unless the plan or the goal is to just leave a massive legacy to their kids and they're trying to just run up the numbers as much as they can, then okay, that's one scenario where taking more risk than you need might make sense. But otherwise, why take risk when you don't need to? So the third factor that we need to consider is skyrocketing unemployment. I'm sure a lot of you have had this affect your families, maybe your kids have seen this happen. I know it's affected my family a little bit. Crazy numbers coming out. This was in the week ending March 21st, 3.2 million initial unemployment claims. Now, what you're looking at here on this chart, you have this trend line, okay? See the trend line at the bottom? That thing, let's see if I can get my mouse. Yeah, so you have this trend line through the 60s and 70s. And these are people that file for unemployment for the first time each week. So, it's pretty high right there in the mid 80s. And then here's 2008, 2009 gets really high. That was about 10% unemployment. Well, then ever since then, it's been smooth sailing. This line right here, that looks like it's a border of the chart. No, that's not a border. That is how much we went up in a single week in unemployment claims. That's unprecedented. And it was even more. I think it was 6.2 million the week after this, but the chart wouldn't even fit on the screen if I showed you that. So I'm just showing you from that initial burst when kind of the whole country went on lockdown, businesses got shut down. This is what we're dealing with. Now, of course, the CARES Act just got passed. That's going to help some folks who went on unemployment. I think that's great. The key, though, is how quick can we get these people back to work? So then, the other thing to worry about is the number that is projected by the end of this. Economists at the Federal Reserve, they're expecting 32%, not expecting, sorry, they're projecting 32% unemployment in the US. That would be 47 million people in the US would be unemployed. It's not looking good. That's the equivalent of New York, Florida, and Colorado. Okay, those three populations combined out of work, unemployed. It's a tough spot that we're in. Once again, key is how long are these people going to be unemployed, and when their jobs come back, will their jobs come back? One is the question, and two, one concern I've seen recently is that we have now beefed up the unemployment insurance. So if people get that call that, hey, we have this job back for you, if they were making minimum wage and now they have kids at home that they would otherwise have to find daycare for, there's going to be some people that don't answer that call to go back to work. So this could be kind of a sustained unemployment issue. So how long will this recession last? We are in a recession. That won't technically come out until GDP numbers come out later, but we are definitely in a recession, a big one. So now the question is, how long will it last? Right now, the stock market doesn't care that we're in a recession. that's pretty much already been priced in. Okay. Now what the stock market cares about is how long will this last? And this chart, what it's showing us is if a recession lasts, let's use 10 months as an example. If the recession lasts 10 months, the S&P 500 on average has dropped somewhere in that 20% range. Okay. You also have a couple that were all the way up in the 30 to 40% range. So we've already hit that. So what that tells me is that right now the market is probably projecting that this recession is going to last about a year, maybe 3/4 to a year. So then the question becomes, what if we start to get news that this is going to last 2 years or year and a half even? You start to get out into the 18-month range, these numbers start to get pretty high, and we have not hit that bottom. We have not hit a 50% drop. This is the Great Depression. That recession lasted 45 months, so almost 4 years, and that's where the market dropped 89%. Once again, don't think that's going to happen. I think we will get, before any of this would happen, I think we will get treatments figured out. But, this right here, this is definitely a possibility. But I hope we're back here. I hope we've already seen the bottom, but we just don't know. A lot of industries are going to be changed forever from this. All right. I mean, airline travel, really travel as a whole is going to be changed forever. There's going to be people that just are no longer comfortable getting on a plane in a cramped environment, close to people. I think eventually you're going to start seeing airlines keep the middle seat open. That's going to lower their revenue. So there are sections of the stock market, sections of the economy that are just changed forever. Retail stores, they're going to be changed forever as well. Some of them won't even survive this, unfortunately. And of course, hospitality, hotels, a lot of people out of work right now. Hotels obviously don't have a lot of business going. A lot of hotels survive because of business travel. Well, right now, a lot of businesses are realizing that they can run by doing virtual meetings. They don't necessarily have to send someone halfway across the country just for a 1-hour meeting. So, we think that the hospitality industry could certainly suffer for an extended period of time, just because once we get through this coronavirus pandemic, there's going to be some businesses that are affected for the long term, and the revenues may never get back to where they were pre-coronavirus. So then, the big question is, when will coronavirus peak? Over this past weekend, I'm recording this, by the way, on April 7th, 2020. So over this past weekend, we actually got some great news. Cases in New York City were starting to, I won't say peak, we don't know that yet, but starting to flatten a little bit. Washington State starting to flatten a little bit. Overseas, Italy starting to get better and better news. So we're starting to get closer to where we might be able to say, okay, coronavirus has peaked. On the flip side, we've also heard from President Trump, who is very, very optimistic about the market getting back open and getting the economy back to running. He even admitted in a press conference a week and a half ago that, this thing could drag out into 2021 before this economy gets back to full strength, gets back to running at full. So, there's just a lot of uncertainty with coronavirus. I think what the market wants to see, what we want to see, we just want to keep seeing good news. We want to see treatments that work. We want to see people recovering from the virus. And we want to see, obviously, a vaccine. Unfortunately, vaccine just takes a long time. They did, this was probably 3 or 4 weeks ago now. They did do the first human trial for a vaccine, but we have to wait at least 12 months to see how that works. So it's going to be a while before, we can all get a vaccine and go out in public. So before then, we really want to see that big, ugly red line. We want to start seeing it flatline a little bit, flatten the curve like we've all been saying. Okay. So those are some factors to consider. Speed of the market, unprecedented. There's definitely room left to drop historically. The unemployment, once again, unprecedented, skyrocketed. 6.2 million last week. It's going to be probably just as much or more next week. Big question of how long is this recession going to last? Yet to be seen. And has coronavirus peaked? So those are all things that we're looking at and trying to factor into how we invest for folks. The only thing I can tell you with 100% clarity is that the only thing that's pretty certain right now is uncertainty. You know, there's so many choices with what you can do with your money at this point. Here in the last couple weeks, the market has kind of bounced off the bottom. So now might be a good time to consider your options again. So of course, option number one that a lot of financial advisors are going to be telling their clients is stay put. Okay, don't do anything. Now is not the time to be making changes. Don't try and time the market. All pretty good advice. Problem is, we don't know if we're anywhere close to the bottom of this. Once again, if you are already have enough saved, your nest egg is enough for you to retire comfortably, it may not make sense for you to stay put. You know, our clients already have them pretty well positioned, but some clients are realizing, like I did at the casino, that they had a little bit more risk than they thought. That they had more risk than they can handle from when we originally got them invested. And that's okay. That's okay for them to admit that. So we're repositioning them into some vehicles that make more sense for them. Option two, of course, is to cash out completely. You know, maybe you just can't handle it. You just cannot handle the stress of being in the market. Maybe you're someone that has so much saved that it doesn't matter where you're at right now. You just don't want to see that number go down anymore. If that's you, then that's certainly an option. The problem is, in my opinion, that when we do rebound from this, there's high likelihood that it's going to be in a V formation. So what that means is, you know, we came down hard, the recovery might be very quick. So if you cash out now, by the time you are able to react and feel comfortable to get back in, might be too late. So that's probably not the best option. So now for the option that obviously I think is the best one, is to have a plan. Now, a lot of you, this is probably what your financial plan looks like. It's a junk drawer of state policies, of just random documents that, you know, you have a bunch of stuff with one company, bunch of stuff with another, and you don't really know how it's going to work together. What we try and do is create a plan and then let that plan drive how someone's invested. So you may have seen our financial house analogy. You know, financial house, we believe everyone has a financial house. The foundation, so down here at the bottom, that's anything that's guaranteed. So that's money that is out of the market. It's not at risk. It's safe and secure. Then you have the walls of the financial house. So that's bonds, real estate, maybe high dividend paying stocks, things that are going to create some cash flow, create some interest, even if the stock market's tanking. And then finally, the roof, that's where the stock market's at. You know, that's where right now it's been a rough month. Now, all of our clients have different proportions in each category here. Some of our clients right now, like I said, are realizing that, okay, I thought I could handle walking into that $300 poker game and have a bunch in the stock market. Scott, I was wrong. Let's shift more into the walls and the foundation. Other clients are taking advantage of the fact that they had strong foundations, and they're taking this as a buying opportunity. They might be taking investments out of the foundation and purchasing stocks at a 30% discount up in the roof. But either way, when I'm talking to clients, we're calling out to all of our clients. And when I'm talking to them, I'm going over their plan. And as long as what they are comfortable with doing aligns with their retirement plan and isn't going to affect whether or not their money lasts, as long as they do, and they can still take those trips once, we're back to being able to take trips. As long as that doesn't affect, I'm comfortable making changes right now. And, most of our clients, yes, of course, they're concerned with what the stock market has done. That they're going to look at their March 31st statement. I'm sure they already have, and get some heartburn about how much their, stocks have lost. But, almost all of our clients are not calling us panicked because we already had this set up. We already have something in their foundation that's safe, that can't be touched by this market downturn. And we don't just have money in the walls and roof, which, a 60-40 stock bond portfolio, that is 60% stocks, which is the roof, 40% bonds. I bet a lot of you, that's what you have. Okay? That's how a lot of advisors do it. Right now, you don't probably have a lot in the foundation. There are products out there where we just think you can get a good return in the foundation without sacrificing safety. So right now, if you put money in a CD for safety, not going to get much return, right? I think I had a client on the line yesterday that was bragging about the fact that they had a 2% 2-year CD. And hey, that's a pretty high rate at the moment. So, but there are products out there that can get you a higher return, kind of based on what the market does from here, but can't lose money in the long run. So I'm going to tell another casino story here to give you a hypothetical example of what that product looks like. And by the way, that product is a fixed index annuity. Controversial product. Okay, some people hate them. Some people, like us, we really like them for the foundation because it's safe and secure. So here's how a fixed index annuity works. Let's say you sit down at a blackjack table and the dealer tells you that, okay, every time you lose a hand, you are not going to lose your chips. Okay, you get to keep your chips every time you lose a hand. Every time you win a hand, though, I'm going to keep half of your winnings and you get the other half. On the flip side, how's that compared to normally when you sit down at a blackjack table? You sit down, you're placing your bet, and if you lose the hand, you lose your chips. If you win the hand, you win, all of the chips, all of the winnings. If I asked a lot of you with your investments, which scenario would you prefer? Scenario one, where you can't lose a hand, but only get half your winnings. I think a lot of you would probably take scenario one, and you would sit at that blackjack table for a long time. That's how a fixed index annuity works. So you cannot lose value if the stock market goes down. If the market goes up, you're not going to get all of the market's returns. You might get half. Okay, so that's how it works. Now's a really good time to be getting into some of those because the market is, has low prices. So if the market does continue to go down, then, you might lose, some money in the stock market, but whatever money's in the annuity will not lose anything. So most of our clients, that's what we use in the foundation. And our clients right now are super relieved that they have those. Like I said, they are a bit controversial. Before we would ever recommend it for you, we'd go over, make sure it fits your plan, but it's something to think about. Okay. And another Warren Buffett quote. We love Warren Buffett around here in the Midwest. You never know who's swimming naked until the tide goes out. So this was me. I was swimming naked when I went out into that poker room and tried to sit down with the big boys and play poker when I really had no idea what I was doing. Right now we're realizing who has the stomach to be fully invested in the stock market and who doesn't. And I just think it's a fitting time to know how much should you have in the market. And that old 60-40 split that a lot of you probably have may not make sense. So if you think that that's might fit for you and that you might want help getting this all figured out, give us a call, 844 Carlson. We'll just set up a 15-minute phone call for me and you to go over your specific situation. Okay, I do not want you sitting at home stressed about your investments. I don't want you to think that if you call me that I'm going to be pressuring you into becoming a client. I'm definitely not going to pressure you into buying an annuity or something. Okay, that's not what that's about. We're just going to be seeing if I can help you in that 15-minute call. Great. If it seems like maybe we can help you moving forward, then we'll talk about what those next steps would look like. But it's not going to be any pressure. We just want to help you out. So give us a call. You can either email Whitney at carlsonfinancial.com, or you can go to our website, fill out a contact form, and we'll get in touch with you to set up that call. In the meantime, try and go out, enjoy the nice weather. April, hopefully we got rid of all the ice and snow that we had a week ago. Go out, have a nice cup of coffee, enjoy the things you can. And I'm going to leave you with this. Maybe. Things that matter, things you can control, these are the things you should focus on. Those that overlap, there's a lot right now that we just can't control. There's a lot of things out there with the coronavirus that they matter, but we have no control over. So focus on the things that you can control and try to enjoy life. I'm sure here in a few weeks, maybe a couple months, we can get back to everyday life. In the meantime, if you want more help with all this, give us a call. We're here for you. Thanks. Have a good rest of your day.